This is the world of Salesforce and Dropbox, HubSpot and Evernote, a world unthinkable without cloud software services. Most businesses and consumers use SaaS every day to get work done. Driven by the internet and ever-expanding availability of bandwidth, SaaS has come to dominate our lives in a very short span of time. But developing a defining service, often ahead of its time, getting users to engage, secure funding, protect IP, and building a truly remarkable and successful SaaS is not an easy task. SAAStories brings conversations with the dreamers and visionaries who dared to think ahead. How they built their SaaS, genesis, struggles, trials, tribulations, and eventually success. Welcome to SAAStories. Thank you for your time and for joining us in this session. I have a favor to ask. While you continue to listen to the podcast, please leave a comment or rating at iTunes or wherever else you get your podcasts from. I personally look at each comment and will give you a shout out to each of you in our following episodes. It means a lot to hear from you. Welcome to this third of a series of special episodes on SAAStories. In this episode, we talk about funding and the role incubators and angels play in identifying great ideas and robust teams. Today we have with us Jeffery Potvin, founder and general partner, Open People Network, and the Supporters Fund.
If you're going to test a product and utilize it, can you get an understanding of testing that product in 11 minutes or in 7 minutes? If you're having a conversation with someone, are you better off learning who they are in the first 7 minutes or the first 11 minutes? As we tested time down, was that the best 7 minutes was not enough time to tell your whole story, but enough time to tell the story that would interest the investor to take it to the next step. So I found that we just worked our way like anything. You just test and test. And we found that 7 minutes was hard on the startups to get what they wanted to say in. But man, when they refined it down and got that 7 minutes in, it zinged. You define the problem on one slide, your solution on the next slide, and everything is 1 point. And people just were like still energetic. They weren't falling asleep, which is key. And that they were excited about learning more and to dive into that deep dive conversation after.
Jeffery Potvin is an angel investor in multiple regions and has invested in 55 plus companies in Canada. He is a member of the York, Spark, and GTAN Angels and Screening Committees while being the driving force behind Open People Network. OPN is a group of angel investors helping accelerate the growth of early-stage startups through the Supporters Fund and Pitchit series. Jeffery is a lifelong entrepreneur with a proven track record of building companies and reinventing existing businesses. Jeffery is a mentor, coach, and loves to climb mountains. Now, on to this special episode of SAAStories with Jeffery Potvin. Jeffery, welcome to SAAStories. I'm delighted to have you here on this special episode on startup funding. You have been doing some phenomenal work with your network and the Pitchit series of events. You have been very active as an angel investor yourself. I couldn't think of a better guest to start the special edition series on funding. Thank you very much.
Subhanjan, thank you very much for having me. I'm very excited to be here today, and I really enjoy listening to your other podcasts. They've been very informative and very exciting, to be honest, really diving into the mind of an entrepreneur and really understanding where they're coming from and how they're doing it. It's been exceptional. Big fan. Thank you.
Thank you. Thank you so much. The first thing I want to ask, whenever we talk about startups, we say either of the two. One, it's about ideas, or ideas are dime a dozen, makes no difference, it's the execution. Where do you stand on that?
Well, I think every great business starts with an idea. And ideas, as you mentioned, there are many of them, thousands of them. But an idea isn't truthfully a business until you execute. And that idea is going to shift because everybody has a different way of seeing the solution that you're trying to create. So I think you really do need to take that idea. And in my case, what I've done over the last many decades, since I was a little kid, I had a folder. I wrote my thoughts and ideas in this folder. And if it bothered me enough, I would go back to the folder and I'd write more notes. And then if it kept bothering me, I'd continue to do that. And then eventually I would turn it into something. And I think that's the planning stage of going into that execution. And sometimes I will have an idea in my mind that will be there for maybe a year or two, but it'll keep coming back to it. And it means to me that I haven't solved that problem. So eventually something bothers me so much that I'll do something about it. And a great example is, as you mentioned, to getting to execution, is that a good friend of mine and I were walking around going in at a record stores a couple years ago, old vinyls, and we were chatting about all different types of things. And we're big fans of different types of movies and things like that. And I had said, you know what, I've been fostering this concept of a movie in my brain for years. And I said, what do you think of it? So I pitched him on it. And we ended up kept talking about it for the next couple months. And then we ended up writing a screenplay. And, that was the execution. Now we tried to move it somewhere, but it wasn't our domain. So the execution got limited because of timing and all the other things we were doing. So we never actually turned it into something that we felt could have been larger because we didn't have the focus and time. And then that makes a difference on how that idea gets executed. So if you're going to jump into something, focus is 90% of solving that problem. You really have to put everything into it.
That's a wonderful note to go back in history and ask you, how did you end up with Open People's Network?
Well, it's a great question, and sometimes I guess I explore why and where this came from. And as we started to run different pitch events, this was a few years ago, I started to try and understand to myself, why did this seem so easy? Why is it easy to run a pitch event? Why is it easy to understand, or easier to understand, where a startup's coming from? So I started to kind of think in my past, and where did all this come from? Because we were already running and gunning. So we were already 2 years, 3 years into this model before I started to ask myself the same question, or someone had asked. And where it all kind of started was, if I go further back, about 20 years ago, I started working for a large retailer called Loblaws, which is the largest grocery retailer in Canada. And just prior to that, I was an entrepreneur, and I was doing code and building networks and gaming platforms, like doing things on my own time while I was going through different universities and colleges doing my schooling. And so when I progressed and went into Loblaws, I started to have this affinity to startups. So as I was coding and working within the Loblaws domain, I started to, I worked a lot of hours. I started learning a lot about the industry, and none of those things bothered me. It was all about the learning. I wanted to learn as much as I can. And the things that I always gravitate to is that any job you take in the world, there's 3 things you need to get from it. You need to learn a lot, meet a lot of people, and make money. And pick the one that's the most important to you, and the rest will follow eventually. And the biggest thing for me in life was learning. I didn't care so much. I didn't care. I wasn't the best at the people interaction, and I never really cared too much about money because I got paid enough to live, and that was happy for me. So I learned how to be better with people, and I grew the other side. So as I was doing this at Loblaws, I spent a lot of time learning. And the great thing that came out of it was that the front end admin people had no idea what I did, but they noticed that I worked a lot. So startups would call and pitch them and say, who should I speak to? I'm looking to pitch my business. And they would, I don't know, for some reason, they were like, we like this guy and he's in marketing or software and manages online or something. I don't know what he does. So they would send me all of the calls. And I would vet hundreds of calls a week, a month, on top of my normal job of running all of the e-commerce platforms. I had built the backends and then managed the online portion of the business, moved over to the business side. So I would sit down with every startup that came through, even at the time when Google first launched, all the way up. And I would work with them to pitch them into Loblaws. So I'd find the executive that fit under that realm, and every startup I'd find a way to find a door for them into the business. But I would restructure their pitch because I wanted them to be successful. And I remember boss or superior at the time saying to me, I had pitched him a startup and said, this is going to be huge for Loblaws. And he said, we're not here to make a small company big. Our job is to support a big company. And I was like, are you kidding me? These guys have a tech. They're going to save us time, money, effort. They never understood it. So I tried my best, got a lot of companies in front of a lot of people, but that was kind of the starting point. And I continued to work with startups and pushing them through big companies. I went on my own, and that was 15 years ago. And I decided to create a software company called Hardboot, and we do resourcing and project builds for enterprise customers. And I continue to work with startups until I got to the point where I could invest in them. And at the time, I was investing my time into them, but I never got paid for it. I never took equity. I just worked with them because I just loved helping startups win. And then I became my own startup. I continued to grow the company. We built offices in Pakistan, Philippines, and Toronto. And as we were doing that, I continued to figure out ways to help startups until I could start investing. And then I started to invest in these companies, either cash or development projects. And about 6 years ago, 5-6 years ago, some of the companies that we had invested in came to us and said, hey, we really need your help focusing on investing, getting investors. And I didn't think anything of it. And I was like, okay, I'll see what I can do. I'm running my own company, but I'll see. And then it happened again and again. So I started to listen to the voices that were around me and said, there's something here. So let's create an event. And I had invested in a space that I thought, well, we could run them here. So I ran downstairs and talked to the other owners and said, hey, what do you think if we ran an event? We'll call it Pitchit. And they said, okay, what are we going to be? They said, we'll use it as a lead generator to help people find out about this space. We'll run pitch events and we'll give them feedback and help them with their business. They loved it. So 5 days later, we had a free drink night to entice people to come out. And 60 people showed up. We had 4 or 5 companies pitch. 3 of them we invested in, but we didn't want to tell anybody because we felt that would be misleading. So we just kind of went with the flow. And after a bunch of deals happened and people got investment and we were like, wow, this is crazy. We just thought it would be a showcase. So there was deals going on upstairs and this was kind of exciting. So people said, you should do this again. It worked really well. So, and it was just a simple format. We had, at the time, we called it our best 11 minutes because we were mirroring how angel groups work, which was 11-minute pitch, which is crazy. That is way too much time. And we worked with them to get their pitch ready. And we had 4 or 5 people that we knew that sat on a panel to give feedback on their pitch. And they said this was great. So long and behold, we dove right into it after that, and close to 100 live events and offline, online events. 4.5 years later, we've helped thousands of companies and talked to hundreds of companies a month and try to figure out how we can help early stage companies prepare themselves for funding from an angel perspective, a VC angel, instead of just being some random stuff that we're trying to help. We wanted to make sure we could really align with their initiatives and see if we could help align their business fundamentals and their story to help them move forward. And I'm sure there's a lot of other stuff, but that was kind of the starting point. Long-winded story of how it all started, but that's where it became something that was pretty exciting and I guess a passion I've had for a long time.
Well, it's fascinating because there are so many questions I have. The first thing is that when you were in the previous job, the grocery company, what kind of ideas actually were you championing? Do you remember any of those companies?
There was. Well, the one that come to mind when you first asked was, it was when Google first kind of got onto the scene. So we started working with them and I could have got the email Jeffery at gmail.com. And I was like, another email? Who needs this? So they were one of the companies, but there was a lot of startups that were more earlier stage than Google. But we worked with a lot of different brands on back-end code because it was deep technology at the time. So one of them that probably pops up the most was a company called Thin Data. Mm-hmm. And they were Canada's largest email business. And the gentleman's name was Chris Carter. And I interviewed him maybe a week ago. And the reason why it was exciting was because he was one of the first real founders that I connected with. And I really enjoyed his style of running a small business. And we stayed in touch over the years. So I got to learn a lot from him in his journey and what he did. Another company that was earlier stage was called Caboose, and I ended up going and working for them. So they poached me out of Loblaws. And it's a funny story on how it all connected and worked. But I was at an event and sitting at a round table with another startup, which was a startup for moms. And she ended up selling her company a couple years ago, which was phenomenal. And they were the ones I tried to get into Loblaws, where I was told we're not there to build small companies. And then Caboose was sitting at the table, the owner of the company. And at the time, I was a young guy, but he also was a young guy. And I had no idea that he was the CEO of a company. But we were just chatting away. And I really enjoyed what they were doing, his business. And then it just ended up happening serendipitously, I guess. About maybe 4 months later, I was in Vegas, ran into him. Mm-hmm. And then he made me a job offer and said, you should come work for us. So we ended up vetting through it. And I decided at that time that I really wanted to be in the startup world and not working for a big company. And the big company didn't deliver on what I wanted. So I jumped ship. And there was a little bit of a bidding back and forth. And I was excited to move into the startup world. So there was a lot of great companies that we worked with. We were very inventive at Loblaws. And I will say what I liked about Loblaws is that they tested the limits on innovation. Mm-hmm. They also wanted to be the forefront in tech. And at the time, when I worked there, we had a team of over 500 IT staff. So everybody was working on things to enhance and build out the company and to stay competitive, which, I think a lot of times we hear stories that businesses don't stay competitive. They don't understand the shift of time. And these guys really were able to counter that and make sure it happened. So I learned a lot from being able to bring startups in, even if they wouldn't take them all the time. I still learned that this culture really was innovative and wanted to expand and stay competitive and bleeding edge on things that were going through their networks and how they were operating.
That's great. When you did that first pitching event, how did you manage to get the angels into the event?
That's a good question. And the reason why it's a good question is because it actually was something that I had to build. So I guess when I was younger, I never looked at, there were certain areas that I never really dove into because whatever the reasons were. And I found later on in life that it was interesting when I started to look back, the things that I didn't care for were the things that I ended up doing the most of. So, and what that meant was that I never cared for accounting or finance, or math. So I kind of just played it off. I was good at it, but I never really said, this is what my career should be in. And it's funny that the grades that I had the best marks in ended up becoming the thing that I did the most in, which is finance and business. And then on the side of money and investing, I didn't know too many people that had money. So it was never something that I chased or knew anything about. So it just all again happened by fluke, if you will. Mm-hmm. I was invited by the city of Ajax to come to an event. And it was Startup Durham was going to be pitched. And it was a startup group across Canada. And I literally drove a half an hour past the event because I just couldn't get myself to go to it. And just the anxieties of having to go to these different places. So I eventually coached myself to go and said, just suck it up and go. So I eventually drove back. I was probably 45 minutes late, showed up for the event. And in this event, they were pitching a bunch of different things around how this community needed startup advisors and help. And this was the group that was going to do it. And I could only handle the conversation so long before I had to jump in because a lot of the logic wasn't there. The data wasn't backing it and supporting it. So I brought that up and it ended up that conversation that I brought up countering what was going on because of the numbers not matching. It ended up turning into a project and a few investors who were angels were in the room, which I had no idea about. So they actually came to me and asked me to more about myself. We started talking about how I invest and help early stage companies, and then they started to bring me into their fold. So my first real angel investment meeting was with Spark Angels out of Durham region. So I showed up at the meeting, and there was 50 other like-minded investors in the room, and I was like, this is amazing. Where am I? Even though in the past I had helped startups pitch in front of angels, but there was maybe 3 or 4 angels in the room, not 50. So that's kind of where I got excited, and I started to come to all their screening meetings and come to their events, and I learned a bit about the process and what was going on, and I saw that I did all the same things and that this was a natural fit. So when we started our event, the first couple of events were just business people, because I didn't know any real angels that would be wanting to come to this. But as I started to work in these events, I started to realize like these people were looking for deals, and we were running an event that had some great deals. So I started to, just from my questioning and just from my asking information of the startups pitching, it drove interest in what we were doing and who I was and what was this going on. And then I was able to ask them and say, hey, we kind of run this underground event. Would you be interested to come check it out? And that's where it started. And some of these people started to get interest in what we were doing and saw that there was an audience and saw that there was some great startups. And that was kind of how I got them in there. So I think I was building the one and then lured them in with the attention of the other.
That's very interesting. So in a timeline, the first event that you described, which was 4.5 years back,
yep.
Right?
Correct.
From there, your connection with the Spark Angels group and the Durham region group, how separated were they in time?
Well, the first year, so 5.5 years ago, we started doing podcasts, interviewing big business and startups and trying to help them make a connection in those interviews. So in that time period is when OPN started. We didn't have a name for it. So then we created a name and started the events. And probably just about 3 months in, maybe 2 months in of running the events, if I remember correctly, is when I started going to these angel groups. So that's where it started to move quicker and cascade. And then when I kind of realized what these groups were about, I started getting introduced to other groups. And I started to see that this was such a large system. And in order for me to really understand what angels were looking for, I treated it like I was doing it. I'm a journalist and I'm interviewing everybody. I started going to all of these different groups. So I was part of 7 different angel groups within maybe a year or 2. And I was part of all their screening committees. So I wanted to see the deal flow that was coming in on one end and then figure out how can I be more effective to the startups on the other end. And then that way, when we were pitching them, I could see which deal flow was coming through, which ones were getting success and which ones weren't, and why they liked them, why they didn't, and started to mirror those things together, and then checking on which ones got investment, which ones didn't. And I started to build up the criteria, even though I had been building this for 20 years, 30 years in my mind, and in Loblaws and everywhere else, I started to see which ones were winning and which ones were vetting, and then started to kind of put together my own criteria on why they were getting investment. And then how can we better improve these startups so that all of these groups of people will have bigger interest in investing in them?
It's time for a short break. So what gets startups funded and what makes for a successful angel investment? Stick to the knitting, Jeffrey suggests. And it is important to put in the full effort. When you are investing in startups which are in the domain of your expertise, that is when the probability of success becomes overwhelmingly favorable. And a lot more. Stay with us.
You are listening to a Business Podcast Network original. Podcasting is the fastest growing content marketing opportunity, which is untapped. We can help you craft your audio strategy and help leverage the wide reach and easy streaming capability that the smartphone penetration provides. It is easy, it is powerful and personal. Talk to us to find out how podcasting can help you build your brand and reach out to your targets like never before. Write to us at bpn@bizcast.in. That is bpn@bizcast.in. Business Podcast Network. Podcasts end to end.
Welcome back. I'm Shubhanjan Sarkar, your host for SAAStories and founder of Pitchit, the buyer-seller engagement platform. Right before the break, I asked Jeffrey what makes for a great angel startup fit, and he was explaining how ensuring that angels stick to domains they're experts in gets the best results. Listen in. So please unpack this, what you understood, the criterias. Why some ventures get funded and why some ventures are not getting funded.
Well, I think the original hypothesis I went in with was that 50% of the companies that were pitching, they just had a terrible delivery. They didn't understand their business enough. I think a lot of people say, oh, this is what I do. I sell this widget. But the business is more than that. And I think people just lost how to share that, the business modeling and how I make money and how this business will grow. And I think when we came in and I noticed that, it was, well, how can we improve that and turn this more into a business pitch than turn this into just someone pitching for money? Because there are two different things. If I'm an account manager pitching versus a business owner, there's two different ways of looking at your business. Yes. So we wanted to make sure that the right look was coming out and that people understood what they were really selling. So what it came down to, why people weren't investing or why people were, that was the first hypothesis. I think it sticks still to today. I think that angel investing, early stage investing, a lot of those investors are business owners. So they have a different perspective on what they see as being successful and what they see moving through the world that they're in. And because it's early, a lot of it's guesswork. A lot of it's herd mentality. What did they do? If they invest, I'll invest. And that goes all the way up. But I think that it lacked the real deep dive understanding at the beginning. And I think that because it's not a full-time job, it's not your focus, that when it's not your focus, then what it becomes is just an asset class that you're throwing and sprinkling money in and assuming that it's 100% risk. So over time, I thought, well, if 1 in 10 companies wins, which is the chimed line, why would anybody want to invest in this? Like, you have and win could be interpreted in so many different ways. A win could just be that it sold itself or it lost money or that it failed, but it was still successful because someone bought it for a few dollars and maybe you made some money. So, it's not like it's a unicorn and then they say it may pay off your other investments or it may not. So it just seemed like, why would anybody want to invest in an asset class that has such a high potential of fail? So I kind of wanted to shift that view and look at it that every company is potentially solving a grander problem. And if they're not, how do we shift them into solving a better problem so they will get pickup and that we can make investments that would excite our investors, but in that case, it was just myself. But when we progressed into the fund, that we would want to be able to find the best companies and make the best investments. And just like anything, you learn as you go. And the focus that we have, because we do this every day, the other angels that do this every day as a role and job, we were able to connect like that because they were in the same mindset, they were in the same focus, and they were driving in the same direction. People that are coming in from outside and sprinkling investment in, it's great. They have a lot of knowledge and a lot of value they bring to the startups, which is huge and so needed. We need more people to spend time helping startups. But their perspective is a little bit different because they're coming in as a part-time investor, just like a part-time stock trader or a part-time anything. You're part-time. You're putting in half the effort that it takes in putting in the full effort. And does that full effort benefit? No, there's people that have been successful investing part-time. There's people that are successful doing it full-time. So there is a lot of different luck and understanding and guesswork. But I find that the people that focus the most on their domain invest in companies that are successful because it's their domain, which doesn't push it far from the tree. So it allows them to find bigger, better success stories in their investing. So if you do come in as an outside investor and you're only part-time, if you can focus your investments on things that are relatively close to you and the domain you're in, you will find faster, better successes because you can see those wins. Everything else then becomes that high percentage risk. If I'm a software guy and I'm investing in retail, that should be really high risk. But if I'm a software person investing in cloud and I work in cloud, there's a pretty good potential I see the miss and that I can support them, help them, guide them, give them a lot of value in growing, and they're going to win. So I think that's where you start to see better investors come in when they're hyper-focused on the areas they know, and that really drives home runs. And then you do have investors that will sprinkle investments into companies because that person was helping them. And then that is a great way of building more success as well. So it's a really refined ecosystem of entrepreneurs, successful entrepreneurs investing in new entrepreneurs and utilizing their back experiences to help them grow. So I think there's a really good ecosystem there that can only be built on and grown. And I find that those are the ones that are successful. And the startups, when you're trying to figure out which startup is going to be successful in all of this mix, earlier on, a lot of it plays off the success that those investors came in and when they came in, because they really do help mentoring, coaching, and support. And I think it plays a big role in startups progressively growing quicker and moving through the ecosystem. On top of the 8 million other things we could say about why startups are successful and what makes a successful startup, but that's the starting point, I believe, in a lot of these companies.
I can totally make sense of what you're saying. So you are saying that in the angel groups that you are in, the initiative is being taken by people who understand the domain, and then others who are not part of the domain follow that lead. Because, for example, if you have 5 friends who are investing together and you understand the domain, you go ahead and say, I think it makes sense. I'm putting in $100,000. You guys can chip in because I understand this. So it's sort of like that's where the community knowledge sort of plays out, right?
100%. That is the best way to do it. And you see a lot of syndications like that happening now, especially in the US, where people will do that. Agreed. It's taking domain expertise and saying, you know what, these guys are going to be successful because of X, Y, Z. And then they could use an SPV to go in and round up a few other investors to come in on that. And that's common as well, because of that one person's domain and feeling excited that they can help them grow. And then it becomes connections, sales, all of those good things that the group can help drive that and help with that special purpose vehicle investment opportunity. So, agreed.
Great. So let me take a step back to your event. So one of the statements you made some time back was that your first event was 11 minutes of pitching and you thought it was too long. So tell me, what is the right time, and is it actually feasible to judge somebody, even if it's 11 minutes, to judge somebody and say, this is worth $200,000 at this point in time?
For sure. And my brain is going through real quickly on an analysis here for you. I guess you kind of have to look at it that if you're going to test a product and utilize it, can you get an understanding of testing that product in 11 minutes or in 7 minutes? And can you get an understanding that would say, I'm willing to take this product home and try it, test it, and dive into it in 11 minutes or 7 minutes? If you're having a conversation with someone, are you better off learning who they are in the first 7 minutes or the first 11 minutes? So for me, I try to learn as much as I can in the shortest amount of time to then decide where I want to go. So because I know that I have limitations on taking in information, I find that if we're having a conversation and you're drawing out your conversation just to fill time, it would drive me crazy because I would be thinking to myself, I don't need to fill an hour. I need to fill 20 minutes because I want to give you the best information in the shortest amount of time. So in the same context is how I would look at a startup pitch. Is that at 11 minutes, I felt that I was telling you information that was irrelevant just to fill time. But I felt that as we tested time down, was that the best 7 minutes was not enough time to tell your whole story, but enough time to tell the story that would interest the investor to take it to the next step. So, and what I mean by that is that I can give you enough high-level detail in a pitch that will excite you and get you interested in my problem and give enough metrics that would allow for you to convert versus trying to feed all of this information into a pitch that would then get boring and dry out and you get tired because you're like, man, this isn't very exciting anymore because I already went through all the excitement by just being able to tell you how great this problem was. So we continued to refine it down so that if we went to 5 minutes, I found we lacked information. And I found that 9 minutes, it was just still too long that people were falling asleep. So I found that we just worked our way like anything. You just test and test. And we found that 7 minutes was hard on the startups to get what they wanted to say in. But man, when they refined it down and got that 7 minutes in, it zinged. And people just were like still energetic. They weren't falling asleep, which is key. And that they were excited about learning more and to dive into that deep dive conversation after.
Wonderful. So how would you typically suggest a startup breaks up that 7 minutes?
Well, we kind of have it. There's a bunch of different solutions, I guess. But the way we look at it is that you define the problem on one slide, your solution on the next slide, and everything is one point. They're not there to read your syllabus. They're there to overview it. And your talking is the sell feature. So they want to understand how you articulate yourself, how you move forward in a pitch. So the key is that you have a one-line problem, shows your focus, your solution, of course, can be opened up to the spectrum of how that solves your hypothesis. And then you're going to dive into market segment, size of market, so that shows you know what's going on. I like to then talk about your timeline, where you came from, even if it's only been a year, because some it could be 3 or 4. It just shows what major accomplishments you've done, and then maybe a couple points of where you're going. And then you're going to talk about revenue generation. How are the different ways that you can generate dollars from your customer? And then you're going to put revenue projections together. And then you're going to probably jump into high level. I'm, of course, thinking this. You'll probably jump into your team slide. So who are the teams that are going to help make this successful? And then you talk about a couple of the players on the team that are really going to be the home run hitters. And then you're going into your ask and your need, and then exit, and obviously the type of investment you're looking for, the vehicle. So I think that kind of gives you a well-rounded presentation. There might be a slide or two different that you'll add in there. Just off the top of my head, there's probably another one I'm missing, but give or take, you're looking at anywhere between 8 to 10 slides. And again, you're doing an overview. You're not teaching a lecture. You're trying to get people to be interested in you and what you're about.
Wonderful. So 3 quick follow-up questions. One is, what kind of sectors do you see getting funded? Is there a flavor of the year kind of scenario that you see emerging over the last few years? 2, what is the typical size of investment? So a lot of times people may be approaching a group expecting to raise, say, $500,000, but that group is good to go for, say, $200,000, and that mismatch and that pitch level itself will disconnect, no matter how exciting or interesting the thing is, because the group will just not be able to pull it off. So what do you see in these two? A, segments, B, size of investment.
It's interesting because we see pitches all over the world globally, and they're in all different verticals. Most people tend to fit in the same verticals because a lot of people work and operate in those sectors. The emerging ones tend to be the ones that are the problem in the market at the time, or the ones that get the most marketing when you're reading the news. So obviously in the autonomous space, Tesla, massive, everybody talks about it. So you have a lot of startups that work in that type of space. Is it the right space to get into? Well, because it's in the forefront of everybody's mind because of Tesla and all these companies pushing it, there's obviously going to be a lot more success coming out of it. 4 or 5 years ago, the autonomous vehicle space was very tough to get investment on. True. Now there's accelerators built around it. Now there's dollars built around batteries and everything, right? So it's following, they call it the herd mentality, but you're following kind of what is going on with the herd at the time. And a lot of it's based on what's in the news. So because of COVID, you have healthcare being a massive, massive one right now. And again, is that going to change in the next couple of years? Probably not. Prior to that, healthcare was pretty massive as well, but it was kind of blinded out because people were just saying it's too hard to get in this space, so they just wouldn't bother because of the bureaucracy. Well, now the bureaucracy is being let down because they're struggling to maintain a level playing field with the cases and trying to drive tech. So now you're seeing a big shift where they're opening up doors. And that goes down to security, privacy, and things like that that can cause that from growing. The next big one, of course, is, and now it's growing really quickly, ed tech is another big one. And the reason ed tech is taking off is because of people working from home in schools. So that space is really starting to drive. Now you're going to say that it could be oversaturated, but the great thing that's going to come out of this is that it may be oversaturated with startups getting into the field that has a lot of bureaucracy as well from the schools all the way down because of security and measures that are needed. But the reason that's going to change is because someone's going to come out with a more effective way each time. So you're getting a lot of focus in there. You're going to get a lot of great, cool businesses that are going to come out of it. And we see a lot of really fascinating businesses come out, and they are getting funded. So these are all things that are happening because of the environment that we're all facing. So you're going to see more things come out of it. Sports tech was another big one because people want that comfort of watching sports, but you can't see them live. So there's a lot of products coming from that. The other one that I guess becomes really popular now is fintech, because you have the same conversions that need to occur because people are buying online more. So fintech has really taken off in the last couple of years. You have blockchain with Bitcoin going obviously gangbusters because now you have commercial investors jumping into it. And then the next big one is real estate. So prop tech has really taken off. And again, the reason prop tech's taken off is because the world of commerce is got to a crazy point in time right now where everything is so expensive. Everything is, how inflation hasn't crushed anybody yet. It makes no sense to me. I think the governments are afraid just to say that inflation is hitting us so that they need to take measures to correct it. They're afraid to do it because of, well, we don't need to get into the politics side of it, but that's also caused properties to go up to extreme amounts. So now you have new businesses coming out trying to get you to buy a property, but doing it in fractional because it's the only way people can afford to get into property. So the world's shifting to an unbalanced position where everything is about commerce. And because commerce is driving everything and people are realizing it now, everybody wants to be an investor. It doesn't matter who, what, where, when. You've got social platforms that are allowing it. So you're opening up the measures to say, hey, world, you're all allowed to come in and do this now, which I think is great and should occur. But what that does is it means there's more money, more risk, more challenges, but there's more of it. So now that means that valuations go up. So everything starts to create bigger demand. Everybody wants to be in somewhere. And you'll find in the next 3 to 4 years, maybe it was cool to be an entrepreneur and an investor. Well, that'll start to dwindle down and people will realize that maybe big business is better because you can make more money and it's more solid and you don't have to worry about the stress of trying to build something from scratch. So all of these things fluctuate with how the media drives things out and how they drive your attention. From an investor standpoint, there was maybe 2 months where you could get an amazing deal on a startup because people were panicking and trying to find money. And now it's reversed back to before the pandemic where every company with an idea is worth 10 million and every company executing is worth 20. So it becomes a lot more, it becomes a tougher process to look at investing in companies and getting into early stage because downstream has moved down or upstream has moved downstream and downstream's trying to move upstream because you're both competing with each other saying, well, I want a stable investment because I need returns so that I can keep investing. So they go upstream and then the downstream or the upstream go downstream because they want better deals. So they're now pushing downstream. So the money keeps revolving and the investors keep driving the value up. And now the chase is higher because the competitive side of investing goes up because everybody wants that next best rocket ship idea. So startups start to see this and the demand goes up. They start asking for more. They start driving out higher salaries because they want to move quicker. So the whole thing moves up. So now people are asking for more money to survive. They're not treating themselves as a startup. They're treating them as a Series B company when they're in a pre-seed because they're seeing what the markets are doing, right? So they want the talent. They want all these things so they can be successful. And rightfully so, they should. So the environments are shifting and changing a lot because of the amount of commerce that's out in the market and how that capital is being pushed into startups. So I think you'll see this run for a little bit, and it'll continue to drive that way. So you're still going to get the pre-seed and seed round investing, 500,000 to $1 million investing. And hopefully those companies are able to learn quick and pivot and grow in the environment they're in.
Great. Where do you see syndicates like AngelList featuring vis-a-vis angel groups like Spark Angels or similar ones? Did you see any difference, or do you think this is the same thing?
Well, it's an interesting question because when it comes to investing, you could say that there's a process. You early stage, you come in at this, you raise a valuation, then you go to the next stage where you're going to raise again. And if you follow that sequence, it's crawl, walk, run, same idea. That if you follow in this sequence, you'll be able to grow your company and take investment at the right times, and you'll be able to manage it and control it if you go through that. And I think that in the environment that we're currently in, there's crowdfunding, there's social funding, all these different ways that you can generate dollars. And maybe at first I thought, well, this risk is already super high. Why are you now going to people that are 1/10 of their time is spent investing and you're getting money out of them? That's even higher risk. And you're burning people's capital. But if people want to be in the space because they want to invest like a shark or something, Dragon's Den, then we should allow people to do that.
Sure.
We should allow people to manage their own risk. And if that's the case, they want to manage their own risk, then they can do their own homework and decide which ones they want to invest in. That will build future investors and build up future wealth. So I think it should be opened up. So then AngelList and all these other platforms, they're all doing great things because what they're doing is they're putting the startup to the forefront, and they're making them more important. So they're allowed to now find all these different avenues that will create value and give them funding. So AngelList, angel groups, VCs, social funding, crowdfunding, all these different platforms help that startup get positioning and build value so that they can continue to raise funds as they go and get themselves ready for that VC world. Because by the time they get to that VC world, if they're not hitting certain criteria numbers, they may have a tougher time closing deals. And if they're not at a profitability and self-sustainable, then they're going to be in trouble and they could fail. So because there's a lot of money at the top, but they're selective on what they're getting. There's not a lot of money at the bottom. So if you open it up to the public and allow more people to come in, then it becomes more supportive to that startup, which creates jobs, creates value, creates conversions, and builds capital in a smaller market or in a massive market that's only small funded. So now you're going to get a really good base there, which I think is more helpful because the funnel looks like this. There's 5,000 companies a year in Canada at the bottom of the funnel with the least amount of funding, and at the top of the funnel, you've got 5 billion. And you only have 300 companies. So you can see that it's oversaturated in money. Not enough great companies succeed to get that far. But at the bottom, we're not opening that up. So how do we open that up? And AngelList and all of these angel groups are a huge way to help build that value at the base so that you can get stronger companies. And you do this long enough in a new country, in a new startup country, or you do this long enough in Canada, North America, like Silicon Valley, what you're going to do is that belt's going to loosen and you're going to open that funnel. And as longer you do this, then there's more money coming in at the bottom, more startups having a potential for success, and then you can grow that faster. And that means you need to open up all channels of investment and educate the startups that there are other vehicles to go for funding.
Great. So my final question, how much should a startup be diluting or should be wanting to dilute in the seed round where you operate?
So in a pre-seed and seed round investing, it really depends on the uniqueness of the business and the potential of the opportunity. There's two ways that I look at a startup or in investing. It's either you sell the dream or you sell the data. Because you can't do both at the same time.
True.
And if you're selling the dream, you can demand for anything you want. because it's a dream and you haven't executed, you haven't done anything. So you can get a 10 million valuation, but eventually the data is going to prove if you're worth 10 million or you have to down round. Or you use the data, and the data can be the biggest carrier of the value of your business. How many people you have signed up, users, clients, dollars, conversions, all that. So it's one or the other at the timing you're going in. And where does that valuation start? I would say 95% of startups in a pre-seed round are going to be up to 5 million in valuation. If you're going into a seed round, you're probably anywhere between a 3 and maybe 8 million, give or take. And if you're really a rocket ship, which is that other 10%, your pre-seed round could be north of 10 million, and a seed round could be just north of 10 million as well. So we don't see a lot of companies that are coming in fresh into the market at a valuation of 10 million. But if they've got great clients and a great value, then it's worth it. And you have to look at it that they were able to build up a lot of that data and conversions earlier on, and that can bring a lot of value to the company. So before you dilute yourself or how you dilute yourself, I think you need to evaluate positionally where your business is. Is it generating revenue, generating data? Is it profitable? And everything you can do to de-risk your business is going to bring the value up. The people on your team, the numbers, the conversions, the advisor panel, the people that believe in you, the earlier investors that came in, all of these things help you de-risk your business to bring the value up in that. But I think a lot of times we focus in on our first business that I want to own all of it and I need everything. I think you need to plan those stages of investment. You need to plan the execution of those dollars. And the people that are successful aren't doing this ad hoc. They're doing this calculated by, I've got 12 months runway. I'm going to start raising at this point. I need my sales at this point. I need my data at this level, because that's what's going to help you keep building forward. Most companies on the stock exchange and being traded, they have gone 10, 15, 20 years and never been profitable. They've been using capital to generate and drive their business, and maybe now they're shifting to that model. So it's possible to do that, but do you always want to be out pitching for money your entire career instead of growing and building a company? So I think if you can find a way to balance what you take in as growth money every time,
yes,
and the rest of your company is building off of the metrics that are sustaining your business in case there is a downturn, and that you're being aggressive on managing your expenses to ensure that you have the capital to continue growing.
SAAStories is brought to you by Pitchlink, the buyer-seller engagement platform. Pitchlink enables high-quality interactions between buyers and sellers through presentation and discussion modules. Sellers create personalized sales presentations and reach out to prospects through a non-intrusive, buyer-qualified engagement. Pitchlink requires no installation or download and holds the entire repository of sales collaterals and buyer-seller conversation. Talk to us to know more about how you can engage with customers without intrusion. Call us on 990-216-3132. That is 990-216-3132. I think this has been most helpful, and I honestly feel that we should hop on another chat where we can dive into a little more detail about Pitchit, the event, and actually what goes on, the inner workings and all, because there are so many things that you are doing, and I feel that at many levels this might have been an inadequate chat, but at many levels this has been a very satisfactory chat in terms of what we have been able to get from you.
I totally appreciate all of your time. And I can say that it's not very often that I get to dive into the intricacies of the environment that we're in, but I can say that over the decades that I've been in and out of this space, and the last 5 years that I've been focused strictly on early stage investing, I can say that it's pretty amazing space, and there's a lot of people that spend a lot of time helping startups. And I've been a big cheerleader of startups for 20 years, And I'm glad that you took the opportunity to reach out and dive into the conversation with me. And I do love the banter, so hopefully the next one we can bounce a lot more ideas and concepts around. But I think that it was really enjoyable to share the journey and the next 10, 20 years of diving into startups. I think the world's going to keep changing, and it takes a lot of good people like yourself and others out there that want to explore and give this detail out to the audience so that they will also look at wanting to give back and participate in helping grow economies. And it does start with one person putting a few dollars into an idea and a concept, and you never know where that can take it. So, but I thank you for spending the time with me.
Thank you, Jeffrey. We have a fantastic lineup over the next couple of episodes with great conversations. Coming up next episode is Nick Hollinger, co-founder of VisitorQ, a visitor tracking software that makes it easy to follow up with those hard-earned visits to your website.
So there's a few ways that companies action on the data. There is a bucket that's just like, I want to know the company's visiting my website. I might not take action every day, or might not take action at all, really. They like to see who's on the same reason you look at Google Analytics, right? You might not have too much action there. You might see your visitors are 1,000 one day and 1,200 the next, and you're like, okay, that's great. I'd like to see that. And then the other bucket is on the marketing side, where if you're like, I pushed out this blog content, I want to ensure that we're driving companies to it, that it's companies that are going here, or how is AdWords doing? Is it driving actual companies to our website? So it's more on the marketing analytics side. And then the third bucket, which is probably our biggest use case, is with sales teams. And that's really the key to VisitorQ. If you want to get an actual dollar value return out of it, a hard dollar in, a hard dollar out, is using it from a sales team perspective. But there's a number of different use cases with the data.
Subscribe in your favorite podcast app so you do not miss a single episode. Thanks for listening. Thank you for being with us today and listening to this episode of SAAStories. This is where I speak with the dreamers and visionaries who dared to think ahead and build world-class SaaS products. We hope this conversation helped you with the insights that you can go and apply right now to your own SaaS journey. We hope to have you here with us again in the next episode of SAAStories. SAAStories is brought to you by Pitchit, the buyer-seller engagement platform. SaaS Insider, the definitive community for global SaaS, and is a BizCast original production.